Hello, everyone. This is Ivan Illan, the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. Thank you very much for joining me on this podcast. And I wanted to talk this month about one of our research highlights, a recent one that we published just yesterday. And it's dealing with a subject that I think is being discussed quite a bit right now, which is the nature of the US dollar, its perceived weakness. Certainly, year to date, we've been seeing uh, so much weakness in the US dollar that non US assets, like non US stocks, for example, have been significantly outperforming domestic US stocks to the tune of about 1,000 basis point differential in performance. A lot of that outperformance of these non-US equities has been coming from the fact that the US dollar has been actually falling in value. And so this is a very real driver of total return for portfolios. And your exposure to currency risk is a very real thing. This is something that good financial advisors spend a lot of time trying to assess within a portfolio of their clients, which is how much currency risk do they really have? Portfolio managers, of course, think about this also. And there are ways to avoid currency risk within the US market if you want to. For example, you can buy ADRs, or American Depository Receipts, which are shares of stocks that are overseas that are denominated and trading here in the United States, denominated in US dollars and trading in the US market. However, of course, their revenues underlying may be derived from in some other currency or even multiple currencies, which of course is the case for most US multinationals or just global multinational corporations, regardless of where they may be headquartered. So this research highlighted, if you go to our website at alignwealth.com, you will see, and there's a link to it in the description of this podcast, you will see a couple of charts. And these charts are meant to give you some perspective on the value of the US dollar historically, but also what that has meant for non-US stocks as well as for US stocks. And I think one of the things that I've certainly noticed over the past 20, 30 years in this business is that a lot of people think that when the dollar is weak, that actually favors US multinational corporations, because so much of the revenue, such a big percentage actually, and in often cases the majority of revenue that comes from a US multinational is coming from non-US sources, coming from overseas. And so when the US dollar is weaker, the idea is that there will be more demand for these US multinationals' goods or services. Well, this is a very nice idea, but in practice, we don't actually see this relationship dynamic work out precisely in this way. And what I've done is I've highlighted a couple of periods of time, certainly the recent period of time where we've seen the US dollar really over the past decade, since 2015, it's only up about 7.33%, but it's oscillated between being down almost 9% and up nearly 18%. So that's quite a wide swing that we've seen over the past 10 years. But right now it's up about 7% in value relative to where it was 10 years ago. But what's very interesting is looking back at the period of time of 2005 to 2015, that decade period, and you find something very interesting there. Of course, not only was there the great financial crisis during that period of time, but there was a period where the US dollar had basically fallen 15% relative to the its trading basket of currencies. And it was up as much as 20% during that decade, but that came at the very tail end of that decade period. And for most of that decade, from 2005 to 2015, the U.S. dollar actually was lower and had been really generally weaker relative to its basket of goods. So you would think that during this very protracted period of time, where the U.S. dollar was actually weaker, for many years, that you would see U.S. equities actually benefiting from that. And in fact, you saw quite the opposite. You actually saw international companies and international stock markets performing significantly better than the U.S. domestic market. So this is, of course, very topical right now. This is front of mind because we are in a period of geopolitical pressure and strain because of tariffs and retaliatory tariffs. And what does that actually mean for global trade? What does that mean for the consumption and domestic consumption within the US, domestic inflationary pressures within the US? And what does that mean in terms of other countries, namely China, showing up more significantly, opportunistically within the global trade picture, global supply chains, and beyond China, of course, just looking at all of the other ASEAN member nations, the Asian, Southeast Asian nations, and really looking to take up this opportunity where they can, now that the U.S. is really positioning itself in this particular way. And certainly for the U.S. consumer, it's definitely, in my estimation, an inflationary pressure, whether you're now exchanging something at a high price that you normally would be importing, you're going to be buying that from your domestic producer, which, in our estimation, is benefiting small and mid-cap companies, which is why we have an overweight to those size companies within our portfolios domestically in the U.S. And however, increased demand in those in the goods and services of those companies, of these small and mid-cap companies in the U.S., that will create increased demand, which increases the price equilibrium point, which is an inflationary pressure. So there's almost no way of escaping the inflationary pressure in the short term. Maybe in the long run, there could be some easing, but ultimately, that hasn't been something that we've seen play out in that particular way. So check it out. Check out the link if you have further interest to really read more about the relationship between the U.S. dollar as well as the U.S. stock market versus the non-U.S. stock market, and specifically what that particular decade from 2005 to 2015, which was such an interesting decade, obviously marked with a global recession, by the way. So it can give some very interesting insight to what may be rolling out here and essentially demonstrating itself over the next several years as these economies become dislocated from one another. They're becoming more independent and less integrated to one another. Certainly the U.S. becoming less integrated to global supply chains, and certainly from a global consumption standpoint, if these tariffs persist, which personally I can't imagine that they would persist. But oftentimes, companies, if faced with challenges, they will look to seek alternatives within just a matter of months. Think of the pandemic period. Companies pivoted very quickly in their supply chains, and many of those supply chains have remained intact from the pandemic period. So when there are pressures like this or instigations like this, this becomes a catalyst for a change that essentially becomes more permanent. And that is the danger of this type of tariff negotiation tactic. So keep that in mind. And of course, if you have any other questions, don't feel hesitant to reach out to us, you can contact us at info@alignwealthllc.com, and we'd be happy to get back to you and answer any further questions you may have. Have a great day.